It seems like we're headed in for a mildly positive start actually. About a 0.5% uptick is what was indicative in the pre-open rates itself. And that's exactly how we've started off. 0.5% higher, 21,800 now for the Nifty spot. And the futures are already inching higher towards that 22,000 mark. But very quickly, what is Paytm up to? Let's bring up that stock. That's been the most news-based, and that's where you've got a queue of sellers really down again 20%. 487 is where that stock is right now. So it's been opening at lower circuits itself for the last 2 consecutive sessions. What are some of the other names up to? There were a lot of earnings reactions. Let's start off then with IHCL and what that stock has been doing right now in trade. I can see some positive ticks coming in, 500 plus levels, 3% higher for IHCL as we speak right now. There's Abbott also, good numbers coming in there, EBITDA jump up of over 24%, margins have expanded to 27%. Abbott is the other one which will come up for you on your screens. MGL, which is looking to acquire that 100% stake in Unison Enviro for 562 odd crore rupees. That's the other stock which is in focus. If you can just bring up Abbott as well for you. Good numbers from Ominda Corp, JMM Fodler. Remember, these are very high HNI concentrated stocks. And of course, Motown has come out with a healthy report card so far for January. You saw that big bump up on Maruti yesterday. Hero MotoCorp, the Jan sales have come in higher, 21.6%. For TVS Motors, an uptick of 23%. Exports as well have seen an uptick of 22%. So most of these auto stocks are seeing a follow-through come by from yesterday's price action. That's not quite the case for Eicher Motors though. Royal Enfield sales have been down 2%. Emphasis, weak numbers there. The constant currency revenue growth is below the street estimates. Margins as well have seen a slip come by. Bata as well, poor performance there. Indus Tower, wherein there has been that sizable block deal. KKR, CPP have both been sellers. Sonata Software, City Union Bank, they've all had a weak earnings report. Actually, you can see that play out on the stocks. Ajay, anything in specific that you're spotting?
Well, the shoe bite in Bata is quite surprising actually. One would have thought that the numbers would start improving. Pull up Adani Ports. Adani Port came out with a number which appeared to be a slight on the weaker side to the brokerage community in general, but many are missing out that their margins are actually heading above the 90% mark. Adani Ports is up by almost 4%. PB Fintech will also come up on your screen, very important one. Yesterday, one of the most marqueest names in the entire emerging market basket have been a big buyer in. Capital International was a big buyer in PP Fintech. The stock is lower, but we'll keep that on your radar. Let's also get you some opening trades. The first trade which is coming on Nuresh and Kunal's screen. Kunal, let's start with you.
So that will be a buy on L&T Finance. That's a stock which has shown signs of recovery above 170 levels. So would look to trade the stock at the open.
Right, Nuresh, what's the first trade that you're punching in?
So that would be a buy on Naukri Info Edge, which is testing that support at 4,900, 5,000. We've seen good momentum across the new age space. So this could be the one which could be next.
So let's take the discussion now forward on the fundamentals front. Mahesh Nandurkar is joining us now, Head of Research and MD at Jefferies. Mahesh, afternoon. Thank you so much for your time this morning. You may have analyzed the fine print of the budget quite closely, I'm assuming. We went to the budget, with a very low set of expectation, this one being vote on account. But in general, the street has a habit of building expectations even when they don't warrant any. But it came out as a prudent kind of a budget, minus all the populism. From the street point of view, how much would you give this budget out of 10?
I think, first of all, I would say that this was an important budget. The word interim or the word vote on account is just a technical terms. But I think it's the budget to watch out for in my view, because what we've seen historically also is that, if you look at 2019 as an example, then there was hardly any difference between the interim budget numbers and the final budget, that was ultimately presented. And, also if, one, assumes that the same set of people will be presenting the next one, it would be very difficult to deviate from the February budget. So I never took this budget lightly. I, always looked upon it as the budget. Maybe some small tweaks can happen here and there, but I think the broad pathway that would be set out in this budget would be the one that would continue post elections as well. So that's first point. The second point, as to how do I look at this budget, I think it was one of the best budgets, in the sense that, given the environment that we need to undergo fiscal consolidation, and I think the government did an excellent job on that. In fact, they they delivered numbers which were better than market expectations on the fiscal consolidation front. The market was expecting about 5.3, 5.4, and what they've targeted for the next year is actually 5.1. So much better than what market expectation was. And I think even more than the fiscal consolidation, what I find the single most important point from the budget is the balance between the expenditure growth. On the capex side, the growth is almost 16-17% on a year-on-year basis. And on the non-capex side, if you exclude interest payments, is actually a decline of 1%. So clearly, the government has told us the direction in which they want to move. And in a pre-election budget like this, the split is plus 17% for capex and minus 1% for non-capex. You know what lays in store for you over the next few years if the same government were to come back. And I think that was a very, very important messaging from my perspective. We have been, quite positive and quite optimistic on the whole capex cycle to start with, and this budget really comes across, as a music, in that context.
Mahesh, hi, morning. That also sort of somewhere reflects that the government has confidence in re-election come May, right? And that's purely a big cue for equity market watchers.
Absolutely. I think there was generally there is still and there was the consensus expectation, around the political continuity, but that was the market expectations. And I think with the budget that was presented yesterday, the government has endorsed, that market view, I would say.
What's your stand as far as the capex number is concerned? Though, some see it that last 4-5 years, the run rate was anywhere between 30% on average. This time 11% appeared slow. But the other camp is that the base in the last 4-5 years, or the peak of COVID lows, has actually expanded a lot. So even 11% is a very healthy sum, or record high 11 lakh crore thereabout. How meaningful does it appear to you? And do you think it's also an indication to corporate India that it's about time that you may also want to loosen your purse strings towards capex?
Yeah, actually, just to be sort of correct on the numbers, it's actually not 11%, it's actually 17%. With that 11% is from BE to BE. But if you look at the revised numbers that have come up for FY24, from those revised numbers, it's actually 17% up. So the capex growth is not 11%, it's actually 17%. So just to be correct on the numbers. I think that's a very meaningful number because, as you mentioned, while over the last 4 years or so, we've been seeing a 25 or 30% kind of a growth, but that was on the relatively lower numbers. But now on a higher base, and we are looking at a 17% growth. I think that's a meaningful number. And mind you, we're also looking at this number in the context of fiscal deficit actually going down by sort of budgeted to go down by 80 basis points. And in that context, the 17% growth number looks very attractive to me. And as I said, it's not just this budget. I would actually extrapolate, this strategy of the government over the next 5 years, if one assumes that the same, government will be coming back. And I think it's a clear message that it's the investment cycle which the government wants to encourage. It's the broader investment through infrastructure and in manufacturing, so on, is what the government wants to encourage. And I think the equity market investors clearly need to take cognizance of that.
So from an equity standpoint, Mahesh, where do you think this year is headed? While, of course, the market is doing what it's doing, but FIIs continue to elude us. You've got two big events, both the US elections as well as our very own elections. You've got another budget as well lined up. And then, this is in the backdrop of all the geopolitical tensions which are, continuing to spiral up.
Yeah, so, I would say that, so over a period of time, we've realized that we've got a very strong set of domestic investors, as a large, asset class, which has now been supporting the markets. I agree with you that over the last couple of years in general, we've not really seen meaningful inflows of, from the foreign investors. But, I still continue to believe that this year will be the year when the dollar peaks out and there will be rate cuts by the Fed. And I know that the expectations around the Fed rate cut keep on changing. I mean, we started the year with almost 150 basis points, and now we're talking about a number slightly lower than that. In the recent communication, the Fed seems to be giving a message that we should be lowering the expectation of a rate cut in the March 24. So there are some things like that. So some changes might happen here and there, but still the central messaging is that whether it is 150, whether it is 125 or 100 or something, there are going to be rate cuts in the US. And I clearly believe that that will mark the peak of the US dollar and would be, an excellent environment for emerging market as an asset class to do well. So I still continue to expect meaningful FI flows this year. I mean, last year we got about $20 billion, but according to me, that's a very, very small number. And I'll not be surprised if we actually see inflows from the foreigners, which will be a multiple, of that number. That still, is my base case. So yes, the markets have moved up, but if I go with the the current investor positioning of foreign investors in India, I think is very, very light. And in the context of this expected weakening of the US dollar, I do expect strong foreign flows, and I don't see any reason why the domestic flows should weaken. So my sense is that we are still looking at a decent 12% plus kind of returns for the broader market, and obviously some sectors, especially gearing towards the capex, some interest rate sensitives will actually do much better.
Mahesh, I see that you are incrementally negative on rural side of the plays. Whereas, an observation yesterday, day before actually, was the commentary from Godrej as well as Dabur seem to be suggesting early green shoots in that zone. Now this entire, part of the market which is sensitive to volume growth and margin, etc., got hit by inflation issues. Does it think that worst is priced in there? Or you think it could be longer and street is perhaps becoming impatient and getting in these kind of names?
So selective names will definitely do well. But, when we talk about, underperformance, or when we talk about the street is, not acknowledging these numbers, I think we have to look at a slightly more historical context and not just limit ourselves to what has happened in the last 1 year. We have to, look at the starting point 10, 12 years ago in 2010, 12, that many of these, consumer stocks were trading at 20 times, 22 times 1 year forward earnings. They went all the way up to like 60, 70 times, and we have seen some valuations correction towards 50 times multiple or thereabouts. So yes, there will be a bottoming out of the rural economy because, if you're looking at a positive, outlook for the capex sector, the construction sector, it's ultimately the rural, laborers that would be, seeing the ultimate benefit of it. So I have no doubts in my mind that the rural economy will bottom out, at some point in time. But the re-rating that we've seen in many of these names over the last 10 years, going up from 20 times to like 70 times, I think that, needs to kind of, retrace, especially because one large segment of the market, which is, all these like capex related sectors, which was completely ignored by the investors for the last decade, is now coming back into focus. So there is, going to be some continuous allocation of monies away from expensive consumer names to some of these capex and real estate and other interest rate sensitive sectors. So that, I think, is a much longer term theme that we have to keep in mind. So in that context, yes, while the rural sector will bottom out, I would still be more optimistic on the cyclical side of the stock markets.
Mahesh, great to have you in the show. Glad that you could make time and join in as always.
Thank you very much.
Okay, that's the view coming in on the budget and overall markets from the of Jefferies. Let's just restock what the markets are at. By the way, we are well above the 21,900 mark, on our way to chart that 22K level on the Nifty. Look at Abbott India. That's a big move on the stock, reacting to its positive numbers. 5.5% higher is where that stock is. Ajay was making the point that Adani Ports and the margin expansion is something that the street perhaps ignored yesterday. But to be fair, the street was very, very sedate and tempered yesterday. Today, you're seeing a big move on the stock. 3% higher is where Adani Ports is. Z as well has jumped up about 2.5% or so. And look at BPCL. In fact, not just BPCL, the entire OMC cluster, that as well off late has seen a bit of renewed vigor. BPCL also is making a dash of about almost 3% in trade today. But still in the thick of earnings, so let me welcome on board CK Venkatraman, the MD at Titan Company, joining in on the show right now. Venkat, hi, great to have you on ET now. And after a weak December, you've seen better demand in the month of January, clearly. Tell me, what's the outlook and visibility for the jewelry segment going forward into the next quarter?
See, the jewelry segment is, category it's got multiple things going for it all the time, actually. And, even though it's a high ticket category, it's a store of value. It's so much into the essential wedding purchase. And the Tanishq brand and the other brands in the company are very strongly positioned. And therefore, despite once in a while monthly blips like what happened in December, our confidence on a medium and long term is very, very strong. And as we said on the call, January has been very good and better than December. And we are quite confident that Q4 will turn out to be like that.
Venkat, how's the non-jewelry part of the business was slightly on the lower side. Was it also a one-off kind of a soft patch? Do you expect that to come back? I'm talking about eyewear, watches, all of that.
So if I look at, speak on the sales growth, the jewelry sales growth was very good. The watches and wearables division sales growth was very good. The Taneira business sales growth was very good. The international business was excellent. The sales growth was a challenge in eye care and in the perfumes businesses. And the profit performance was a little muted in many of the businesses for the quarter. Okay, so if I look at the sales side of it, we have done many things in the eye care business in the last many weeks, and we expect a big change to happen certainly in FY25. And given the overall opportunity in that segment and the way the brand is actually positioned with these corrections, with these changes, we're very confident that FY25 will turn out to be a good sales growth for both the eye care as well as the perfumes businesses. All other businesses have done very well in terms of sales growth, and it's just going to be our job to extract more value from the operations than we perhaps did in Q3.
That perhaps I missed it, but maybe if you can reiterate whether or not you'll be maintaining the jewelry EBIT margin guidance at 12 to 13%, because there is quite a bit of competitive intensity too.
There's a lot of action in the industry, yes, but Tanishq is also in some sense unique in its position, and we are quite confident through the advantages of scale, product mix, and overall efficiency of operations. What Ajoy said on the call yesterday, we will continue to maintain that.
One of the reasons why your jewelry sales momentum is pretty strong is because of your network branch extension. Can you talk to us about how's the network looking right in number of branches, stores, I mean, and also the new buyer behavior, I think, is coming back?
We are, I don't remember exact number, but I think it's around 460 odd or something like that is the number of Tanishq stores that we have. And the opportunity for Tanishq to keep expanding the network continues to be very, very strong, because jewelry is a very deeply penetrated category. We have got hundreds of towns in India where we are present in many, but we can still go to many more. So therefore, the expansion opportunity is quite strong for the next many years. And even as urbanization is increasing, more and more localities are springing up in every large city, and stores in each one of those new areas is another possibility as well. So the expansion part is very strong. The new customer thing continues to be a focus for the company, for the division, and the typical challenges that come up, particularly in the middle class, is that the overall economic situation in the middle class. And if you look at many of the sectors which depend on the middle class for their overall business, slowing down. So that is the only challenge. But we've got multiple brands in the jewelry business like Mia and Carrot Lane, which also target the younger person, younger woman, the more affordable segment and all that. And with that whole portfolio, we are quite gung-ho about new customer acquisition as well. And every new store that we are setting up, whether in a new city or in a new locality, maybe 90% of the sales of that is from new customers in any case. So the network expansion also drives new customer acquisition in a big way.
I also wanted to understand as to what's happening with your international expansion.
Doing exceedingly well. It's almost like, our feeling that why did we wait? We should have gone a few years earlier kind of thing, but that's okay. I think things happen at the right time for a reason. But every store that we just opened our Chicago store, I think about 10 days back, and I just got a mail this morning from our North America head, and I saw the pictures of the store. Consumers are just raving about the Chicago store and what it has and the store experience, the design. So we're making a big mark, not just in terms of sales, but in terms of the overall customer proposition with Tanishq, and every aspect of it, from design, quality of finish, the range width, the store design, the store experience, technology that we're using for billing and all that. And the customers are just really loving it. And we are creating fans in every city that we're opening in GCC, in North America, and in Singapore so far.
In sub-zero temperatures, if you're getting long queues outside your Chicago stores, must be quite a sight in itself.
I don't know if we're getting long queues in sub-zero. We got long queues outside the Dallas store in November when it was not so bad, the weather. but we are certainly having, creating huge number of fans in sub-zero temperature. When it is outside sub-zero, they're all inside, but.
Great. Great speaking with you, Venkat. Thank you so much for taking the time out, and congratulations once again on your earnings.
Thank you very much. Yeah, thank you. Bye-bye.
Let's just take stock of what the market is up to, because that's where it's all glittering right now. We're counting down to that fresh all-time peak. By the way, we're already 22,000 when it comes to the Nifty futures. Adani Ports, of course, is your big mover from within the Nifty names. Reliance has surged up very, very smartly today. You're seeing already Reliance hit a fresh record high for itself. It's almost counting down to a 2% move. If we can have those intraday graphs, 2.25% actually, 2,900 plus levels in Reliance. ICICI Bank has surged very, very sharply today. And I think this kind of a move in ICICI Bank is also coming after a long hiatus, because I think, Ajay, ICICI Bank underperformed along with HDFC Bank.
Actually, ICICI, out of the private sector pack, beyond HDFC and when HDFC and Kotak were massively underperforming, people latched on to ICICI first because the earning quality was very good. So last the 4 quarters after that, it was a big beneficiary. And now it is coming back after a bit of a break. But there are 2 stocks I'd like to highlight for our viewers, which took a massive drubbing yesterday, and people were scratching their heads what exactly has happened. One is Aurobindo Pharma. Put Aurobindo Pharma on an intraday basis. In the second half of the trading session, you came to know that there were certain checks happening there. And the fall yesterday, the 10% fall corrected, and then a bit of a rebound. So it's flat. Incremental fall is not coming out there. Results are next week. Watch out for that one. And the other one is Fusion Microfinance. That one fell 12% in trade yesterday without any clear reason, but is now staging some amount of rebound. Again, results are next week, so keep that on your radar as well.
Yeah, absolutely. Absolutely, but the other one that's on everyone's radar is Paytm. After yesterday's smackdown, today is absolutely no different, despite assurances from the management in their conference call and a tweet by Vijay Shekhar Sharma saying that the app is working, we will continue working beyond Feb 29, and for every challenge there is a solution. They are committed to serve the nation with full compliance. In fact, let's just understand what has transpired, what brokerages have to say for Paytm. We've got Gaurav to break it down for us. Gaurav.
Yes, so we have got some strong words from RBI coming up for Paytm, and we saw that RBI has now not allowed bank to take any deposit or credit transactions in terms of from the customers. And on back of this, we saw a huge decline coming up in the stock market. The stock was down by 20% for the second day in a row now. And what management had said is that they are not going to work with the Paytm payment bank. Although this is not the end of the road, what they can do is that they can transfer these accounts to another bank, which are the corporate banks, and they already have tie-ups with the corporate banks apart from Paytm payment banks. But because they have 100 million active users and almost 300 millions of user base, it may say it takes some time, maybe in a couple of weeks they will be able to do this transaction. So they also said that they have got some proposals from the banks to get the nodal accounts from Paytm payment bank on their books, and they are still reviewing these. The proposals coming up from the bank, but it may take several weeks, and by the start of the March, we may see the transaction getting completed, and within the next 6 months, management is expecting this operations to get started again, and we may also see some kind of growth kicking in. But what Street is expecting is that because the payment services is getting impacted, which is actually 50 to 60% of the revenue, this is going to have a huge impact on the bank's profitability from here on. We also have brokerages coming up, where they believe that JP Morgan has downgraded to underperform at a target price of 600 rupees per share. Jefferies has given underperform rating and a target of 500 rupees per share. Axis has given sell rating and a target price of 450 rupees per share, because the management is also saying that this is actually a bump on the profitability, but there is a road which is going to come out, but there is very less clarity on when the growth can kick in. And lastly, management is also expecting EBITDA loss of 300 to 500 crores because of this move, but this loss is expected only on the back of the payment services business. So basically, the financial services and marketing, although are not getting impacted, but there will be indirect impact on these segments as well. And because of this, we see that the investors are getting very bearish about Paytm.
And that's quite, reflecting on the stock price for a second consecutive day down, locked in lower circuit of 20%. I want to just revisit some of those budget allocation beneficiaries, and let's see what they're up to. I mean, the defense allocation stands at 6.2 lakh crore rupees. At least that is what the interim budget announcement was. So let's see what the likes of Cochin Shipyard, Mazagon, BEL, HAL, etc. are up to in trade, and whether you're seeing these stocks actually hold up. Not bad, actually. They've picked up from where they started off in trade. At least I can see that for Cochin Shipyard. If we can just build out BEL, of course, a smart mover there. Mazagon, not so much. So it's a bit of a mixed bag coming in there. Even Bharat Forge or Midhani, for instance, these are also now players within defense pack, or at least some part of that sector exposure is what they have within their companies. So pretty much across the board, you are seeing a green, at least for the defense names. Now, the more contentious ones, the railways, that is. So let's see, after that allocation of about 2.5 lakh crore rupees, what RVNL, IRCON, IRFC, RITES, etc. up to, because that's where the street is actually a little bit more circumspect. You're actually seeing a bit of a downtick coming in there. In fact, across the board, you are seeing a downtick on the railway names at least. And I want to bring up even a RailTel, Titagarh, Jupiter Wagons, even a BEML to some extent. All of these stocks would have railway exposure. And across the board, you are seeing a red come in. There's also, of course, road transport too, with an allocation of 2.78 lakh crore rupees. So GE Power, Edge Infra, PSP Projects, NCC, NBCC. NCC, NBCC in any case have been quite favorites with the markets. But let's try and understand what the interim budget really meant for the tourism sector, and who better than Puneet Chatwal from IHCL joining in, and I'm going to take it across to Nikunj for that chat.
Change of leadership, and when there is a clear focus on profitability and growth driven with purpose, and in this case, it's customer satisfaction, stock markets, they tend to reward those businesses. Indian Hotel, that in last 10 years, has given you following return. Last 10 years, let's look at the chart. It'll just come up on your screen to establish that what Indian Hotel as a franchise has done in last 10 years. That is followed by a 5-year chart of Indian Hotels. But when I say magic, the real magic actually in the stock of Indian Hotel has happened in last 3 years. Why is the magic? Well, the sector has turned around, business has turned around, and now in terms of the expansion and the forward strategy, Indian Hotel is firing all cylinders. So it gives me great pleasure as always to connect with Mr. Puneet Chhatwal, Managing Director and CEO of Indian Hotels, to take our conversation forward. Mr. Chhatwal, did you like our story of a magical term comeback in a stock 3 years? Before you could finish the word magic, the magic has happened for shareholders.
Well, we are very pleased with the performance, Nikunj. It's always nice to talk to you, and I think the guidance we have been giving on a consistent basis, we have been able to make that promise and also deliver on the promise. And our strategy will remain the same, to be in line with the guidance we give and preferably overachieve that in a little lesser period than that we have guided for.
The quarter gone by is always the peak quarter for IHCL. How was last Q3 different from Q3 of FY23?
Actually, the Q3 in all metrics was obviously positive, but what triggered that positivity is obviously 3 key initiatives that we have undertaken consistently. One is our not like-for-like growth. We opened 16 hotels last year. So as the hotels keep opening, I mean, last year means in the last 9 months, and we are well poised to do 20 openings by 31st of March. Going forward, next year will be another 2 hotels a month. So all these hotels on a management fee-driven business model are adding to the margin expansion that we are witnessing. Our management fee business has more than doubled in the last 3 to 4 years. So we expect that the total management fee income at the end of this financial year should be around 450 crores. Now, this was less than 223 years ago. So that's one, is your not like-for-like growth. The second important part is effective asset management. We have invested 2,500 crores in the last 5 years in upgrading our assets, in upgrading brands to Taj level. 24 of our hotels migrated to Taj, which includes the Fort Aguada and the Holiday Village in Goa, or the Fisherman's Cove in Mahabalipuram. And all these have also contributed significantly in the upgradation of not just the brand, but in the financials. And finally, we continue our focus on the new businesses and the reimagined businesses. New is our homestay, our Cumin, and the reimagined Ginger, the reimagined Chambers is also, and the reimagined Tatsat. That has witnessed a 34% growth over last year. And we have given the statement that we expect these businesses to keep growing at 30%. Our traditional business will also grow, that IHCL at 15 to 17%, but the new businesses coming from a smaller base will grow very fast and become a significant part of our portfolio.
Mr. Chhatwal, your stated objective is of a double-digit growth for FY25. But if you have to look beyond FY25, FY25 will start in 8 weeks from now. But if one has to look at FY26 and 27, what is the probability and the possibility that the double-digit growth will actually be there for at least next 3 years?
Growth comes from your existing business. Growth also comes from your new businesses as well as new openings. Now, we are well positioned to open a minimum of 2 hotels per month going forward. So not like-for-like growth with a pipeline of 85 hotels, which means we would have opened most of these hotels in the next 3.5 years. This does not include any conversion opportunities. This does not include any other inorganic growth opportunities. So with all that put together, I remain confident that our double-digit growth will continue.
Can I assume that 35% will be the new normal for Indian hotels for the foreseeable future, 35% margin?
Well, the guidance we have given is 33, and we do believe that 33 is a very healthy number. If we can get more, why not? If we can, like in this quarter, we got 38.5, we go for 38.5, but a little above 33 is what we are targeting, so that if there was any kind of a downturn coming, if you're positioned at that level and you reduce your margin by even half, you still stay in black and you continue to have profitable growth and a profitable journey.
The hallmark for Indian hotels has been that you are building up the management fee bucket, and that is the real reason why margins are also expanding. So at what rate is the management fee income likely to grow?
Well, we expect the increase in management fee income, anything which is north of 20% per annum. And we have given that guidance also that by 25-26 end, we should be around 550 crores in management fee, which means an increase of over 100 versus the number we are expecting at the end of this financial year. And the flow through of management fee business is very high, as you know, it's anything north of 60%. And with our pipeline being 74% in fee-based business, and a lot of operating leases for Ginger, because we don't believe management fee business is the right way for Ginger to operate. Ginger brand has the capacity to do more than 50% margin. So we prefer the operating lease model. And our owned assets is very few. We have just 2 islands in Lakshadweep, 1 hotel in Cochin airport, which is opening, and 2 in Ekta Nagar that are also under construction. So in the next 5 years, these are the 5 owned assets that we know today, which we will be opening. And the others will come selective investments in strategic locations, and part of the nation building also that we do, that will keep happening. And we think we have good amount of gross cash reserve of already at 1,800 crores. We have enough internal accrual to do so and don't need to take on any debt.
Mr. Chatwal, 2-3 years ago, to talk about religious tourism, that was more like an idea and that was more like a concept. Now it's true. The fact that you've signed up a hotel in Ayodhya and we spoke about it. Are you also factoring in an upswing coming in from religious tourism as we look into the future? Because this is something which now adds a new dimension to your portfolio positioning.
You know, I'm a firm believer that if we don't take into account the first decade of this century, I think spirituality across the globe in all parts of the world is gaining in importance, including in leadership styles. I mean, you know, in some place in your mind, to be a holistic leader, you cannot be just driven by profitability without, as you said at the outset of the conversation, purpose. And purpose has some link to some form of spirituality. Now, we are very blessed because for several decades, our company has been building spiritual destinations. And we are present in more than 50 of those with 60 properties. And we will keep adding. And the good thing about is, unless there was a lockdown like COVID, these destinations have always done very well for us. So right from the north, let's say from Katra, from Vaishno Devi to absolute down in south with Meenakshi Temple in Madurai, or you know, the Tirupati, we are opening our 2nd hotel this month in Tirupati, and Ayodhya with 3 hotels planned. So I think we are very, very well positioned. And the Ganga belt, the way we cover from Rishikesh with the Taj and Anand Kashi on the Ganges, then Pilibhit House in Haridwar to Taj Ganges and Taj Nadesa Palace in Banaras, And the new opening that we have planned in Patna later this year is also, very symbolic of our Ganga trail, that the way we have built it systematically. And Patna would benefit both from being the capital city of Bihar, but also being on the Ganges.
Mr. Chatwal, specifically you just mentioned to the new businesses. And in terms of the new businesses, because the base is different, they are growing at about 35%. But as we look into the future, how much percentage of your revenue in FY25 and beyond will come from these new businesses, the new growth frontiers which you've incubated? I'll just, break this question for the benefit of our viewers, Mr. Chatwal. Allow me to just explain this point. We are talking about Amar Trails. I used to always call it Amar Trails, but Mr. Chatwal has corrected me over the years to call it Amar Trails. Chambers, cumin. By the way, there was lovely, hospitality which we enjoyed yesterday from cumin, and that Chai Pe Charcha cumin show which comes out. So after this plug for ET Now, sir, let's talk about the new businesses.
So new businesses and the newly reimagined. So Chambers is in its 50th year, but it was reimagined 5 years ago. So is Ginger was reimagined, and so is TajSATS. So if we add 5 or 6 of these key new businesses, we expect them to grow to almost 15 to 20% of the total revenue in the next 3 years or so. So, and that is kind of a very conservative, realistic estimate. Ginger itself would be around 600 crores next year. TajSATS should do 1,000 crore revenue. And cumin is all set to cross 100 crore in GMV this year itself. Ama should start getting close to 50 plus. So all these businesses, and Chambers is also around 100 crores in fees. It's not the consumption that we talk about. This is membership enrollment and the annual fee that is paid by the members. And these businesses have a very strong flow through. They have very high EBITDA margins. And we remain very confident that especially brands like Ginger have a very big future in a heterogeneous landscape like India. So a Ginger could be in every district capital, every state capital, every commercial capital. And that is like affordable, lean luxury for everyone. I mean, the target market is around 300 to 500 million people on the domestic front. So I think these businesses will grow in perpetuity. And they may evolve in different form. When we started Cumin, it was only home delivery. Today, Cumin is the all-day dining concept of every Ginger hotel. So it is home delivery plus X, plus the all-day dining restaurant. So I think, and they, match very well together. Both are somehow related to Roots, and Ginger sits in the company called Roots Corporation. So I think all in all, very interesting combination of brands, very interesting future, and very strong growth prospects.
All right. So that was Puneet Chatwal in conversation with Nikunj regarding not only the results this quarter, but also the roadmap for the company. The stock gaining 2.5% after a good result. Talking of good result, there's another company coming out with very good results. That is Praj Industries. Stock may be a little soft today, but what is standing out is the performance. Shishir Joshipura, MD and CEO of Praj, is joining us now to talk more about the numbers. Mr. Joshipura, let's understand the revenue growth may have been slightly on the weaker side, but on a sequential basis, on a YY basis, your order flows also slightly on the lower side, 1,000 to 1,100 crore for the last 6-7 quarters. What has led to that?
So, good morning. So our quarterly order book actually is very, very interesting in the quarter gone by that we're discussing here. We are actually very happy with the mix that we are seeing. We are seeing a clear broad basing of our order book, and it is now going to the targeted goals that we had set for ourselves. If you actually see the construction of the order book in the quarter, we have seen segments like CPG, energy transition, PHS, they all started to contribute in a significant way to this order book. And I think that's a very, very healthy sign for the business, that we are broad basing our order book. And that is what will augur well as we move forward through our journey. We are very, very happy with the construction of the order book, the way it is developed in the quarter gone by. You will recall that This quarter also saw one of the major announcement from the government on reprioritizing the feedstock from the sugar sector, which used to be our biggest segment. And that reprioritization has obviously led to some temporary halt of sorts because people are reevaluating their position. And even in a quarter like that, we saw this whole strategy that we are working on play out. So we are pretty positive about what we have seen.
Joshi Shubpura, the last time that we were talking with you, you were pretty confident of achieving this 4,000 crore rupee revenue in FY24. Given that you've recorded just 2,500 crores in terms of your top line in 9 months, does it seem like 4,000 crores could be difficult?
Yes, a big shift that has happened since we spoke last is what I just mentioned, that the government reprioritized the sugar sector feedstock when they said the syrup-based ethanol production will get reprioritized for the country. We believe this is a short-term arrangement. And as we move forward, we also decided that we will address this whole challenge in a very different way. Rather than just sit by and watch, what we decided was we'll create option for our customers to move away from single feedstocks to a multi-feedstock ethanol production. Because if you have set up a plant, you would like to produce ethanol, feedstock is not such a great criticality in terms of if you have options. And that's what we did, our technology team. So we are now ready to roll out a multi-feedstock option. It may shift the whole effort by a couple of quarters, but we are very, very confident that this is a very, very short blip in the performance.
But at the same time, something which stood out also this quarter was your margin performance. Margins expanded pretty smartly, almost 200-300 basis point. What led to that? Is it a one-off, or now with upwards of 11% will be a new level for margins?
So if you really look at the margin journey, that's something that we've been talking about, that we have made some very conscious efforts to actually ensure that we improve our margin performance. So if you actually look at it over a 2-year period, and it has significantly moved up. Contribution came from many factors. First and foremost is our technology and the play that we upped on our technology side. We have talked about low carbon ethanol. We have talked about multi-feedstock solutions. We have talked about broad basing our product mix. Even between the domestic and international, if you see our order book at 9 months, it's at about 26% international, up from 18%. So we will see many of these levers that we've been working on come into play to actually improve the margin story. So we have no reason to believe that this is a blip in a performance. This is actually something that is a result of our effort over a period of time. So we believe that we'll continue to maintain the same.
Morning. Now, you've also laid that very ambitious target. You want to triple your revenues by 2030. So what really will lead to this growth, this revenue growth?
Well, very interesting. Actually, yesterday's budget lays out a very, very ambitious plan from the government on the whole bio segment in terms of biomanufacturing. The whole bio energy segment has already seen a lot of push coming forward. So I think the whole biomanufacturing push, which government is clearly indicating that they would like to give this a push, we believe will lead to several opportunities as we move forward. Praj has already been working on several of these opportunities. We are already building a bioplastics plant in anticipation that some such thing will emerge in the future. Of course, our effort were based on our read of the way the technology in the society should move to being more sustainable. And now we are very, very happy that government's policy is also indicating it in the same direction. We have announced a large investment in Bangalore facility, where, as I was mentioning earlier, the energy transition segment is globally growing, and we have a very, very strong position there. So that will also start to fill in. So we remain confident that all the CPG segment as well, so that all these actions that we have taken in anticipation of these markets developing will start to play out as we move through 2030. And we absolutely remain confident that we'll achieve that guidance.
Good to know. And what about the outlook? I know you spoke about the international, the margins, but your international margin business, is that margin accretive? And are you working on increasing the share of your international business?
Yes, the international business is margin accretive, and we are very focused on improving the share of business. As I mentioned to you, the energy transition segment is is growing globally, and we have a very strong position on that. The low carbon ethanol is growing internationally, and we have a very strong position on that. We believe that as we move forward through the years, we will see the feedstock equation play out in the international markets in a different form, and we see Europe going the 2G way. So we are very, very confident that all the solutions that we have been working on so diligently for so many years now will start to play out as we move forward through the year, and international market expansion will be one of the key levers for that.
Shipara, great having you on the show. Thank you so much for the for taking time out and speaking with us today about how your earnings are, and more importantly, your understanding of the takeaways from the interim budget and what they mean for you as a company and the overall industry as well.
Thank you.
Okay, that's the word coming in from Praj, the management there. Let's just revisit what the market is up to, because we're doing quite okay this Friday. We've scaled it up all the way to 84 points actually on the Nifty futures. We're sitting at the high point of the day, 21,900 plus. For the Nifty spot, Adani Ports is now up 5.25% in trade. BPCL has climbed up nearly 4%. There's Power Grid, Hero MotoCorp. Infosys is scaled up 2.5% as well, and Reliance is holding up well above that 2% gain mark, a fresh record high for itself, and that alone is giving a good amount of leg up to the index. ICICI Bank, TCS, ONGC, a 2% move coming in there. Tata Steel is holding out very well. And look at Bajaj Finance. After its numbers and the gap down that the stock has, I don't think yesterday as well it did a whole lot. And today you're seeing about a 1.25% move coming in Bajaj Finance finally. But Dinesh Kumar Khara, the chairman at SBI, is with us. Let me take it across to Nikunj for that chat.
Now to bring on board Mr. Dinesh Kumar Khara to talk about budget, expectations, outlook on economy, and thoda hint kal ke numbers ke baare mein. I'll try my level best to get some hint out from Mr. Khara on what we should expect tomorrow morning. So, Mr. Khara, good morning. Thank you for joining us. Sir, the expression on your face is telling me that we are in for some surprises tomorrow.
Good morning, Nikunj. I think we'll have to wait till tomorrow morning to know what really is there in the number.
Okay. The budget numbers, Mr. Khara, are impressive. The fiscal deficit number is quite impressive. And one would say that this is a budget which just instills a lot of confidence in government's outlook for economic growth.
No, you're right. Absolutely. I think the way this budget has come in with the kind of focus on the fiscal consolidation and also the kind of focus on the growth, and that too led by infrastructure. And also the newer focus which has come in for the solarization, as well as for the housing for middle class and also in rural sector, special thrust in these areas. This actually augurs very well in terms of the growth potential which it holds for the economy, and the way it will really roll out in the economy and various economic sectors will certainly be very positive for the overall growth for India.
Mr. Khara, the fact that the commitment towards capex has come down, A, because of base effect, and B, because of government's commitment towards fiscal deficit, could that have an indirect impact on the economy and especially infrastructure sector?
No, actually, what I expect is that normally this kind of government spend on infrastructure will certainly have the multiplier effect, and I expect that even private sector also to come in now. So I think it is going to be a combination of efforts by government as well as the private sector, and which will eventually reflect in the growth numbers of the economy.
So, Mr. Khara, can I assume that this is also an indirect message from the government, and you are in a better position, sir, to perhaps give us the ground reality that in India, finally, that private sector nivesh ka mahakumbh is the word, sir, has started?
Yeah, naturally, the private sector investment is a function of their confidence in the growth potential. And I think sustaining the infrastructure, keeping the fiscal deficit in check is a very clear reflection in terms of ensuring that the economy is healthy. And if at all the economy remains healthy, And this kind of fiscal numbers will actually give confidence to the international rating agencies, which also will lead to an improvement in the rating for the economy as a whole. So I think all this will move towards the lower interest rate trajectory, which eventually is going to be for the ultimate good for Indian economy and the Indian industry.
Mr. Khara, looking at the way how the entire banking sector currently is moving, the war of liability still continues. If I use the private banking numbers for benchmarking purposes, looks like banks will have to shell out that extra, they'll have to walk that extra mile to get deposits now. Do you think the concern on getting deposits and especially low-cost deposits is a real concern and it's here to stay?
Actually, Nikunji, what has happened is that, deposit in the economy is a function of the overall liquidity in the system. That is one part of the story. The other part is that if it is not in the banking system, it is either in mutual fund or it is in life insurance. So the fact remains that these deposits are channelized into the economic activities, either through the banking system or through the markets. That remains a fact. So I think eventually for supporting the higher economic activity in the economy, the need is to channelize the savings into investments. And also the other piece is that if at all the fiscal is the way it is, and also inclusion of the common debt paper uh, in the global index, that will also attract the foreign capital into the economy. So that will also be the additional source which will augment the lendable resources or the economic resources for supporting the growth in this economy. So I think, to my mind, the fiscal consolidation and the kind of taxation numbers which you get to see in terms of GST, etc., this actually augurs very well, because I would say that eventually it should show up in the sovereign rating, and eventually that sovereign rating, improvement in sovereign rating, will also help in attracting the global investment into the economy.
Mr. Khara, the fact that fiscal deficit will come down, India will be part of global bond index soon. The flow into bond markets would be extremely strong, which means that it will have a near-term impact on the yields. Are we in for a regime where we could be in for big treasury gains and a huge uptick in yields, and that is positive for the banking sector?
Yes, I would say that I expect likewise that it should be positive for the banking sector. And yields have already started trailing towards the lower side. And also the lower government borrowing from the system also will leave a room for, it will actually create a space for the private sector also to borrow. So I think all these are the factors which are eventually indicating that there is a ample opportunity, and also I think ample scope in terms of taking the economy to the next level. And I think the way we are moving towards it would be the 4 trillion economy very soon in the year financial year 25. That's what my estimation is. And to become 5 trillion in the financial year 27-28 is almost certain at this kind of a pace.
Mr. Khara, a concern which some of your peers have been flagging off that India's saving rates are dropping. Money is moving into financial markets. While banks are happy that they are getting a lot of fee-based income by selling mutual funds and opening brokerage accounts, but that is coming at the cost of SA, which is having an impact on the liability cost. Is this a sector-wide concern and a genuine concern?
No, I would say that banks are always the channels through which the money moves, whether into investments or into deposits in the banking system. See, as far as channelization of the money is concerned, it will all happen through the banking system. So I think eventually, and that is something which helps the system as a whole to grow, and also to support the other sub-segments of the financial sector also to grow.
So you don't think there is a worry into this drop in savings, the fact that money is moving into capital markets, equities, stocks and mutual funds? That's not a worry?
to my mind, it appears to be a temporary cause of concern, but eventually, if you will look at it in the overall context, see, money stays within the economy, money stays for supporting the economic activity. So far as it is like that, it will only lead to enlarging the pie. And that enlarged pie also will create opportunities for the banking system for shoring up their deposits.
Sir, I'll respect the fact that tomorrow your numbers are there and we are restricted to in terms of specifics for the quarter gone by. But if one has to really understand the big picture, which is what you mentioned, that India will move from 4 trillion to 5 trillion and $5 trillion to 10 trillion in next coming years. It's a matter of 5, 6 or 7 years. Where do you see a huge explosion of credit? Which sector do you think is going to be giving that booster to the India and for a banker and for a bank, that is the next growth frontier where you want to lend?
I would say that perhaps there is an opportunity for all sectors to see the kind of growth and also be it rural, be it SME, be it corporate, be it retail. I think there is an opportunity for all the sectors to grow and perhaps almost at a uniform pace too.
Mr. Khara, when we started the year, the GDP growth estimates was about 6.5%. That RBI number has now gone to 7+, which means we are in for a surprise. You always said that SBI's growth would be a function of the real GDP growth plus the nominal GDP growth plus 2%. So if I add the maths here, what your initial estimate at the beginning of the year is, what the nominal GDP is, and what your formula is, looks like, sir, we are in for some surprise.
Let's see how it really pans out. But what I mentioned was the formula which I believe in is the nominal GDP plus inflation rate is something which is the likely determining factor for the loan book to grow.
But Mr. Khara, just to wrap it up with few last questions. The fact that Reserve Bank of India raised a red flag, at least on the unsecured loan, and SBI has a large exposure to the retail book. What is your understanding of the risk which currently is there, at least in the unsecured stroke, the retail category?
So as far as we are concerned in State Bank of India, I've been saying in the past also and will reiterate, for us, as to the quality of the unsecured is concerned, it is perhaps better than the secured. That is one. And secondly, our unsecured is not actually unsecured because we are lending to only those people who are maintaining their salary account where we have got a very clear visibility in terms of the cash flows. So that is something which gives us, which has led to a situation where the book which we are having is very different in terms of character as compared to perhaps rest of the industry. And but I would also like to mention what perhaps RBI had in their mind was to ensure they were also encouraging growth, but they always wanted that it should be healthy growth. And when it comes to the retail, healthy growth means that the entity or the bank concerned should have elaborate structures to assess the risk, underwrite it, and also to they also must have effective collection machinery so that the book remains intact. Because in case of retail, very often we have seen that there is a tendency, if at all it turns bad, it becomes very sticky. So that is the reason why perhaps RBI has taken some such measures, which ensures that the industry should witness the healthy growth in the retail credit.
So, Mr. Khara, allow me to summarize our today's interaction. And if I summarize our today's interaction on the following terms, that Dinesh Kumar Khara, Chairman of SBI, feels and is of the view that the credit cycle is strong for next 3 years and we are in for a double-digit growth expansion where NPAs would be low, yields would be decent, and corporate sector capex will surprise us. Will that be a fair summary for next 3 years of SBI's outlook?
I tend to believe this.
Well, good to have you, sir. Thank you very much, and we shall connect with you tomorrow morning, keeping fingers crossed that as always you will delightfully surprise us, because we always remember your mantra: under promise and over deliver.
Thank you. Thank you very much, Nikunj. Thank you.